Canada's inflation rate hits 18-year highs. What does that mean for mortgage rates? Hey, everybody. Welcome to this week's edition of the Vancouver Life Real Estate Podcast. I'm your host, Ryan Dash, and I'm here with Dan Wertel. And as everybody sits down and listens to this, they've probably heard the news that our annual inflation rate here in Canada has just reached 4.4%. The last time we saw numbers like this was roughly 18 years ago. And that is a significant number because it'll certainly change the behavior, the landscape of the lending environment, as well as the behavior of many buyers in the real estate market. So, Dan, why don't we just touch on the interest rates first? What did the Fed come out and say here, and what are we expecting in the near term?
Yeah, normally when inflation increases at this rate and hits these kind of numbers, we would expect the Fed to be raising the overnight rate to kind of combat that and keep it under control and within their 2% target. But we are in different times now, and the Fed held the overnight rate at 0.25%. But the big news as well on Wednesday was that they ended their bond purchase program. As well, actually, they kind of adjusted their timeline, if you will, about when to expect interest rates to actually rise. Their forecast now puts it in somewhere around the mid-Qs of 2022, making it the earliest expected date of April of 2022 to see the next interest rate hike. They do expect inflation to stay hot, up and around 5% for the rest of this year and even into a little bit of 2022. When we talk about this, the bond buying program ending, so at the peak of the pandemic here, Bank of Canada was buying up somewhere of $5 billion a week of these government bonds. That is now down to $5 billion a month, which is essentially where it was pre-pandemic. They're basically replenishing the bonds when they come up for renewal. But, that's a big decrease of their weekly purchases. And that will, of course, potentially or expected to have the bond yield, 5-year bond yield increase, which again will lead to more pressure on the Fed to increase interest rates. They're blaming this, of course, on things like the higher inflation and energy prices as to why they're going to raise earlier. Blame the pandemic. It's a pretty easy target, wouldn't you say? Mm-hmm. So the central banks, they've now ended up essentially with somewhere in the realm of $425 billion worth of these bonds. That's an increase of about $325 billion off the $100 billion baseline they had prior to the pandemic. So that gives you, I think they ended up with something around the 48% mark of owning the total bond market. So they've got an immense amount of control over the influence on where those prices can go next.
I remember when 100 billion sounded like a lot of debt. Anyhow, let's talk about some home sales. So interestingly, at least before this announcement, national home sales were actually reaccelerating again, up about 0.9% nationally last month. Outside of our record-setting sort of late 2020 to kind of where we are now, September 2021, home sales are still higher than any other month in history outside of that time period, right? And we've been talking about, how the real estate market has been waning since March. It's slowed down since March, but I mean, the March peak was such an extraordinary peak. It's only a fraction of the story, because if you actually go back and you go and you look at since March 2020, let's go back to when really things took a dive and then the market took a run. Home sales are up 300% since that time, right? But again, the media would rather tell you that, sales are really only a fraction of what they were in March. But really, we have to look at the whole perspective here, because this story, I mean, you're going to hear what sells in the next couple of months, right? And as inflation continues to rise, you're going to hear about how the real estate market is taking a beating now. It's going to start to come down. And we got to remember, guys, that we are still flying compared to where we are across 10-year averages. Absolutely flying, right? I mean, let's take into consideration the inventory story. Maybe, Dan, maybe that's where you want to go with the next set here, because it's the next part of the story, right?
Can do. And yeah, you touched on something important there, Ryan, and that's we take a very important and non-biased approach to this data that we're sharing with people. And we just wanted a friendly reminder of that. We don't have an agenda. We are here to report and educate and share some advice and some thoughts on the marketplace. We're seeing media and independents. Sometimes they do have an agenda and they're only going to share the news that kind of speaks to their narrative. And we just want to remind people that, hey, we're here to share everything across the board so that you can make educated decisions and have that conversation with us. So hopefully that's something that you recognize and that we can continue to share with you. So let's talk about listings. We are talking nationally here. Dropped about 1.5% from last month to 65,000 new listings. 10-year average, again, we love to share the big picture, about 71,000. So down about 8% from the 10-year average in new listings. Now, combine that, obviously, the above average sales that we just touched on with the below average new listings, and no surprise, inventory continues to be the conversation. It's a brand new 20-year low in inventory across the board, down almost 2% from just last month.
Oof.
And we touch on this and it continues to get worse and tighter. 6 years ago, 2015, there were 250,000 homes available, actively listed on the MLS across Canada. That hit a 20-year low last month of 102,000 homes available. A 60% drop in just 5 years.
Whoa.
Ontario has experienced kind of the largest decline here, with active inventory down 38% year over year. Second to that is British Columbia, our province here, at 36%. This leaves us nationally with 2.1 months of inventory total. Keep in mind, for reference, we need about 5 months of inventory for it to hit a balanced market. So if you take all the homes available today and double it instantly, overnight, you'd still be in a seller's market across the country here. That's a very interesting perspective to take.
Goodness.
To think you have to double the inventory and still be in a seller's market, still experience multiple offers. And locally here, yes, we're talking national today, but this number is big and we want to share it kind of ahead of the board news and release next week. Inventory in GVRD has dropped another 8% so far this month alone. We're at fresh 30-year lows in here, and there's less than 8,900 homes available. This is like the fourth straight month in a row of inventory declines, and chances are, with just a couple more sales days here, we're recording this on Thursday, the 28th, it's likely going to be the lowest October inventory number ever recorded. That's the headline, really. That's why things are so tight. And if you are shopping now, I'm sure you're experiencing that exact feeling that you're just not seeing the homes out there that you expected to, or have heard have been in existence just a few short years ago.
Dan, question for you. Do you think, with where things are at currently in the month of October, how do you think sales are going to come out for the month of October? I mean, seeing as we've got, record low inventory homes available, and if the media is going to pick up a story that says, hey, again, home sales are down for the month of October compared to September, or something to that effect. Mm-hmm. We're not going to talk about the fact that there's only 8,900 homes available in the marketplace when typically there's far more, right? So I kind of want to get your perspective as to whether or not you think actually home sales are also drastically down as a result of these inventory levels, not as a result of buyer behavior.
Well, great point to bring up. And shockingly, even though inventory is declining rapidly, again, upwards of 8% just this month, sales are ticking up for the second month in a row. So we saw a very minor uptick from August to September, and we are already a couple hundred units above where we were in September. So sales are
Wow.
actually increasing right now.
Whew. So that just means it's going to get tighter
It's going to get
and
tighter.
tighter and tighter. Yeah. Okay. Well, Dan, I mean, price is your thing. So why don't you keep going with the HPI price here, because it's also a new all-time high.
Yeah. Funny because it's kind of been this conversation month over month over month over month for about a year and a half now. But yep, in Canada, September just saw a brand new all-time high price across the board, up 1.6% just last month, hitting a grand total now, a grand high average price of $750,400 is your national new home price, at a 21.5% increase year over year.
Holy cow.
Yeah, the average home increased $133,000 in value in just the last 12 months. With, of course, single family homes, they led the way with a 25% increase year over year.
Wow. It's interesting too, because, when we had and came out and talked about sort of how this was going to affect people in the first few months of the pandemic, we saw, at least in those first sort of 4 to 6 months, we saw the average net worth of a renter increase by about $8,000, whereas a homeowner, we saw their typical net worth rise by $73,000. Now, when you look at the price point here of where homes are a full year later on, we're actually at $133,000 on average growth.
Yeah, and that's a great segue into the next part of this conversation here about what people are doing with that money. I think it's almost no surprise that people that are feeling home rich right now, sure, if the average person suddenly has an extra $133,000 in equity, a lot of people are going to tap into that. So we know banks are eager to lend right now. We know rates are still hovering around all-time lows. And I think it's no surprise there's a significant increase in homes being bought by people that own at least one other property. So much so that segment of the market, that people that that are buying second, third, fourth properties, it represents 25%, 1/4 of all the transactions from January to today.
Very interesting.
A quarter. So you got to think. I mean, it's understandable. I mean, why wouldn't you?
Yeah.
And the reason I'm saying that is because the government in the last 18 months has clearly shown they're going to protect house prices. They're going to flood the market with equity, and they're going to keep rates low. It's a very simple math to say, okay, well, you're making me a bunch, or my property's going up a bunch of value. I can tap into that. The bank's going to lend me a bunch of money, and they're going to keep home prices going up. It's absolutely no wonder people are using home equity to buy second, third, fourth, fifth homes and provide rental housing. Right? It's not like the government's coming out and providing more housing, at least not to the numbers that are required. So fantastic. Great. Homeowners with equity are helping buy homes for renters that are needed. Double-edged sword. Sure. Play that they're taking away homes from buyers. Yeah, that's one angle. I understand that angle. Yeah, go ahead.
But at the same time, are those buyers even in a position to buy these homes, considering they've now gone up 20 something plus percent, right? So,
while only making that $8,000 a year disparity, right? The economic divide, of course, is just strengthening and getting bigger. That's right.
Yeah. I mean, what's really interesting, I mean, when you look at the average net worth of Canadians kind of since 2015 to where we are today, from 2015 to 2020, the average net worth kind of rose across the board by about 5% every year. Okay. Some years were higher at 7, some were lower at 2.5, but generally across the board for those 5 years, it averaged about 5%. Fast forward to 2021, that average net worth rise went up by 21%. Right? So the last 5 years combined, it was almost achieved in 1 year. Right? And so, when people look at their finances and they consider their homes and they're smart about it, why would you not take advantage of the 20+% they've seen rise in their 1 or 2 homes that they own, and then repurpose that money with very, very, very little or very low interest rates? Don't go out and buy another home, because that's what the government and the marketplace is telling you to do.
Well, exactly. And we're seeing that not only, with investors or people wanting maybe that the first vacation home, second property, following that 25% segment of the market is first-time home buyers at 22%. So 22% of the homes bought in 2021 were for first-time home buyers. And not shockingly, these are largely funded by gifted money. Approximately 30%, almost one in three first-time home buyers are buying homes with funds, down payments, gifted from family members. At the rate of something like $82,000 nationally is the average gifted amount. So simple math here. Okay, my home went up $133,000. It looks like homes are only going to rise. I want my child to have a home. I'm going to tap into my equity and help them buy one.
Mm-hmm.
That's what we're seeing. And then, this has been happening forever for sure. I mean, historically, you go back to 2015, for example, that number was about 20% of first-time home buyers were buying homes with gifted down payments. So it's increased by 10%. We're also seeing, of course, move up buyers getting gifted funds. Mm-hmm. And locally, those numbers are quite big because we know the staggering price of Vancouver homes are obviously at a much higher price point than the national average. And we're seeing somewhere, there's an article recently that said, I think the gifted first-time home buyers were averaging $180,000. But the one that surprised me the most was that the move-up buyers were being gifted from parents as well, in excess of $340,000 for that purchase. Mm-hmm. So they're in a condo, they're trying to get single family or townhome or duplex, whatever the case is, and massive amounts of money are being gifted to help them get into that move-up home.
Well, you got to think, in our neck of the woods here, we have half duplexes that are selling at between 1.5 and 2.3 million, and $340,000. This, barely 20%, right? It's in many instances. So, and that's just to make the numbers work, right? Mm-hmm. Now we got to remember that a lot of this money is flowing from equity that's risen in mom and dad's place, right? So, but I know it sounds like a big number, but to me, I think this has been happening for years. This is, I remember 2, 3, 4 years ago, Maclean's magazine was starting to come out with stating, that the biggest transfer of wealth was going to take place over the next decade, right? And this was going to go from, most of it in debt equity and real estate. I know just in Vancouver alone, there was over $330+ billion in debt equity that was going to flow within families. And so now we're seeing, these numbers, 180,000 to 340,000, and everyone's going, wow, that's a ton of money. But, we did talk about this 4 or 5 years ago that this was going to happen, and now it's happening, right? I guess what people weren't expecting was the coronavirus and all-time low rates kind of exacerbated the whole thing. But, everyone was shocked when this article came out. To me, I'm not all that shocked when you consider, homes on the west side of Vancouver selling between $3 and $5 million, and those families downsizing, and pocketing a couple $1 million as they move to the east side or move out of the GVA completely, right? So is it all that shock that $180,000 to $340,000 is finding their way into children's and staying in the family? No, I don't think that's surprising at all.
Definitely. And it also speaks to the question that we get a lot is people are always asking, who's buying? Who has the money to buy this? Mm-hmm. And that right there kind of answers the question. It's longtime homeowners, right? We know that almost 3/4 of Canadians are debt-free, mortgage-free in their home. So they're sitting on an immense amount of equity, and they want their children in, and now they want their children to move up as well. So we're seeing, it also speaks to, of course, the low inventory, right? Mm-hmm. People are house rich, and now they're helping their kids into one, right? That one home just turned into two. Mm-hmm. And they're not selling this one, or if they are, they're just doing a downsize. So you're not, there's no net change in that home, but you are getting the secondary home here. Plus, of course, all these investors now. So people are holding, families own more real estate than they ever have. This is a big why the real estate inventory numbers are where they are.
Mm-hmm. Yeah, it's interesting because it's also a function of population. It's funny because the amount of homes that were built. Sorry, kind of the last highest number, if you can believe this, was back in the 70s when we were building. I think in the 70s, 1.42 million homes were built, something to that effect. And in the 2010s, it's down to just over a million, 1,080,000, right? Which to me, and in the same time frame, we had population growth in the 70s of 3 million, and in the 2010s, 4 million. An additional million, and we went down by 300,000 in production. And people wonder, where's the inventory gone? And then people wonder why prices are skyrocketing. I don't know.
Yeah. It's fairly simple math when you break it down to that. We are just talking to supply and demand, and that's as just the core root of it. Of course, more people, less building. It's a problem, and it's been a problem for decades now. All right, so quick shift. Let's stay on that population number and talk about what's happening nationally here. Saw about 90,000 people in Q3 here. That's double, of course, what we saw in 2020, but we're only sitting at about half of the pre-pandemic numbers. For example, 2019 saw about an increase of 600,000 people nationwide, wow. And we're sitting at about 200,000 year over year for where we are today.
Our non-permanent residents, they are increasing up 150% in August compared to the same time in 2020. The second highest month on record.
Largely your students, of course, coming in. We'll support that number. And those floodgates have kind of opened up again. Yeah, and don't think that some of those people aren't thinking about their PRs too. I mean, a lot of people come here for school, and then they stay because they like it. Mm-hmm. And I wouldn't blame them. Interestingly, Ontario's population rate is 70% below its peak levels, the lowest it's been in 40 years. And that's a direct result, I think, of affordability. The fact that we've talked about it now for months, that it's the leading province in Canada in terms of lowest supply for homes. So people can't find a home. That's increasing the cost of living. So they're moving, and they're headed east for the most part. Interestingly, I think it's got to be close to a decade ago now, we saw people leave BC at a time when house prices were rising, and they were going to Alberta, where they could make a lot of money because that province was booming. And then we all know what happened to oil. And now they're all back in BC again. That being said, though, with the cost rising, the cost of living, obviously, and inflation rates on the rise, BC is still getting a lot of people coming here, but could we see that change? I don't know. Dan, what do you think? BC, it is interesting because we are experiencing similar numbers to Toronto and Ontario, when it comes to housing and cost of living. But I think where we're outpacing them is we are an underpopulated province. I think there's a lot of room for growth, and I think there's a lot of reasons why people will come to BC over Ontario. Let's say climate, for example. A lot of people find this area nicer. It's obviously speculative or case by case here. It's an individual decision, but there's still a lot of jobs here, a lot of jobs that people can come to and experience. And of course, the outer areas, the island, the central, even the north, there's a lot of beautiful places that can experience a lot of growth. You can have jobs and you can buy homes at a decent price. Right.
I think if Alberta,
not speculative, subject.
Yeah, and I think you might see a growth in Alberta when it comes to population, if energy consumption seems to go the way it's going. Furthermore, with prices being arguably the lowest across Canada in Alberta and Edmonton and Calgary, and great value, it's a good place, like we talked about in a couple of our pods ago, for startup businesses, including tech. We're seeing a lot of, Dan and I have been helping a ton of tech employees here in BC, and I don't think that's changing. I think you're going to see a lot of headquarters come to BC, mostly because of the lifestyle that exists here for those people. But I think you'll see a lot of startups and smaller organizations going to Alberta. And I think they'll go for competition. And I also think they will go there for cheap startup costs comparatively to Vancouver, right?
For sure. And where are they going to live? Where are the homes? So let's talk about housing starts. And by housing starts, we essentially mean building permits that are being applied for. We saw a peak in Q1 of this year of about 290,000 permits submitted nationwide. We're down from that peak, but only a little bit to about 270,000 active out there. But that's nice and high in the sense that it's well above the averages. But houses are not, being built equally, meaning that the single family home segment is really, really being underbuilt at this point. It's like houses permits for single family homes sitting around the same pace they were at in the 90s. With, of course, condos and then purpose-built rentals, are leading the pack. That's what's being built, and understandably so, right? I mean, yes, the demand for single family homes is the biggest, but the ability to build condos and rental homes, I think, is much easier, and I think much more profitable for your average large developer.
Well, and just the speed to bring some of these units to market are going to happen faster in high density builds versus single family. Despite the fact that the single family market is the one leading the pack, and it's what most people want. Rising population numbers put additional pressures on metropolises, right? So you're going to see far more condos and townhomes being built comparatively to single family. Let's talk completions of these housing starts. So the new housing completions are at their all-time highs right now, around 200,000 over the last 12 months. Again, single families on the low end of this. Purpose rental built buildings are leading the way. And most of what's being completed today is just for that. It's for renters. It's not actually for homeowners. Not really going to help the marketplace. Generally speaking, might help float some of those rental market numbers, but generally speaking, I don't think you're going to see a whole ton of help in this inventory discussion.
Very true. Similar to the completions, under construction homes are also at an all-time high. About 310,000 properties are being built as we speak. Condos are leading the way here, with the purpose-built rentals a close second. And once again, the single-family market well behind that. It's just underbuilding for that segment that happens to be in the most demand. And I think, we're still seeing it here. We know if you're going to try and buy a detached home in GVRD, it is highly likely you are going to be in a contested battle to win that property.
Yeah, unless there's something materially wrong with the property.
And I think that's actually accentuated too. I mean, you look at the pre-sale market, where the unsold single-family homes are a record low right now. About 5,100 units nationally are all that's available, and it's never been lower since they started tracking that data.
Wow, interesting. Okay, well, let's segue into mortgage growth, because it's always good to know where the money's coming from and what's happening in that marketplace. So mortgages are up as of August, 0.8%. That's up 10% year over year. September 2008 was the last time it was this high. That seems like an extremely long time ago. Uninsured mortgages for new purchases are up 300% since 2019. Whoa.
Yeah, expand on that one. Uninsured. That means people with more than 20% down are the vast majority of new mortgages. Again,
that makes for a very strong market.
Exactly. Cash rich, people coming in with more than 20% can obviously kind of sustain and handle any type of market fluctuations and cycles. Right? Let's say things do go down 20%. They're basically net neutral in a sense. Now, again, every situation is unique, but what we are saying is you're better off having an uninsured mortgage. You've got more equity in your home. You're a little bit more stable in that environment compared to someone with only 5% down. So the vast majority of people are buying with more than 20% down right now, and that's shown as it's up 3 times since the last 2 years.
Yeah. And I think, again, that flows back to our conversation we just had about families moving money through each other, making sure there's enough money down on the homes, making sure their mortgage rates are affordable, that they can pay them, all those kinds of things, right? That being said, though, with the extreme prices we've seen, banks are making exceptions. 23% of uninsured mortgages issued from January to June had debt service ratios above 45%. The regulators will not like this, so they may implement debt to income limits, similar to what you're seeing in New Zealand, basically 4.5 times of your income to purchase power, right?
Mm-hmm. That's interesting. It's a little bit speaks a little bit of to what we saw in the States in 2008, 2009. They were lending money to people who couldn't afford it. Now, we're nowhere near the ratios they were. Nowhere near, right? We're still talking with stress tests involved and whatnot. But by making an exception, the bank, the lender, the underwriter is essentially saying, okay, we're going to go outside of our mandated 44%, debt servicing ratio and say this person's okay. We trust that they're going to make their payments, and they're doing that almost for 1/4 of every mortgage being issued this year. That does potentially create a little bit of exposure. Again, I think Canadian banks are quite smart. It's the reason they have and own the big buildings downtown. But overall, there is a little bit of risk being implemented into the marketplace by them making this level of exceptions for people.
Yeah, I think that it's case by case. Likely, there's probably some long-term relationships there. They also may have their own perspective on what the real estate market's going to be doing, right? So, I don't think. Canadian banks went through much more difficult times a decade ago. They learned from that, so it doesn't particularly scare me with what I've heard here. I think they're trying to help people in a very expensive market too, right?
For sure. Well, I think everyone, including the banks, are feeling cash rich right now. So they're being liberal in liberal times, and that can
That's a good point.
Create risk. But they kind of do the opposite in opposite times. But we will track this as we do and kind of see where it heads.
What's that long-standing joke about banks? No offense to banks, but they always have money when you don't need it.
Okay, let's touch on rates here, right? Because what is happening with rates? Inflation is going up. That means interest rates are going up, right? Well, fixed rates, of course, are going up quite a bit here. And this is the bank's decision, right? This is not Bank of Canada. And the difference now between fixed rates and variable, we're about 100 basis points different now, which is a big amount. Very big amount. Your average variable in and around 1.25 today, whereas your fixed is upwards of 2.25%. Understandably, everybody wants to pay the least, so we are seeing an influx of people choosing variable mortgages right now. Somewhere around 55% of the recent mortgages issued were of variable in nature.
Yeah, generally speaking, that will continue to push housing prices up, right? Because what you really got to consider here is if you're looking at a variable rate of 1.25 or a fixed rate of 2.25, that means that the real interest rates that or inflation and rates that we're dealing with are more like -3%, right? So it's never been better to take out money right now. I mean, the banks are literally paying for it in many ways, right? But as a result, inflation will continue to creep, which will push prices up, right? And ultimately devalue currency. So they can't hold on to these rates for forever. That's why you've seen the Bank of Canada come out, especially as this inflation level continues to rise, they're going to start to curb it, right? And that's where we're going to see interest rate hikes come. That being said, though, if we talk to a little consumerism here, credit card payment rates are at fresh highs and delinquencies are at new record lows. 1.4% of consumer insolvencies. That's 38% below 2019 levels. So people have cash and they're paying off their debts with it. That being said, we have seen a 8.5% rise year over year. And this is likely due sorry, likely due to the end of curb payments, Dan? Is that what I'm seeing here? Yeah.
That's right.
Nearly 1.5 million Canadians were still getting free money.
Yeah.
That's a lot of free money.
And this is just ended. So people were largely being smart with their cash. A lot of people were holding on to it. People were clearly paying down mortgages, clearly paying down credit cards and whatnot. And so we saw that sort of insolvency rate hit the all-time low just a couple months ago. It has sort of bottomed and creeped up a little bit, and that's likely largely due to things shifting here with people getting off of the curb payments. But it's not like they don't have options now. Because yeah, sure, you've been enjoying this quote unquote free helicopter money for 18 months or so, and now it's stopped. What are you going to do? Well, there's literally a record amount of jobs available, and people can go back to work now. And it's interesting because the employment levels have actually just recovered. Employment in Canada is equal to where it was pre-pandemic, but the job hiring intentions, the amount of businesses that want to hire people is at the highest in history. At 68% of businesses plan to hire as opposed to firing people this year.
Well, that includes our real estate team, right? I mean, I know I have lots of clients who are business owners. All of them are trying to hire people right now, and it's very difficult for them to find people to work. So yeah, that shift back to the workplace, we need to see that. There's money that needs to go into the economy here, right? A lot of this cash that people or businesses are wanting to spend on employees will find its way back into the marketplace. And hopefully that's one of the things that'll bring inflation down.
Yeah, I think we're going to see high employment numbers over the upcoming months here, just based on that one metric alone, that curb is largely ended and jobs are plentiful. So, there's going to be an opportunity for a lot of people to have their sort of pick of the litter. They can get new jobs. I know salaries are increasing too. So let's expect employment numbers to get even better throughout the next couple quarters here. But let's do a quick little shift here. We've kind of shared a bunch of data, and it's largely positive, if you will. But there's always risks in any marketplace, and now I think those pressures are increasing. Obviously, there's a big focus here on inflation. That's my guard dog. Yes, Moo.
Inflation. You heard about inflation?
Yeah. We're at 4.5% here. We are the highest since 2003, 18-year high. And it's more sustained than the Bank of Canada has really expected. So much so that they came out and said that 14 of the CPI subcomponents are operating at above 3%. And this is the highest since the 90s. The highest since the 90s, with this being led, of course, by fuel and food hitting record high prices. So what's going to naturally happen? Consumer spending is going to lower.
And that's really not what we want. We don't want consumer spending to slow down too much right now. It's that'll hurt the economy. Ultimately, a lot of money has been put into assets. Not a lot has gone into the economy. So we need to see some of this consumer spending stay in the economy. It's going to keep businesses floating, right? It's very, very important part. So with the 5-year yields of 80 basis points since the start of September, fixed mortgage rates are set to rise around 60 basis points. Expect maybe 2.75%, somewhere in and around that range, right?
That's 2.75. That's a significant increase. For a minute there, you could get a fixed mortgage at around 1.5. So we're a full 1.25% higher than the all-time lows that were experienced at the beginning of this year. So no doubt people are going to variable.
Yep. Canada's debt to GDP, I don't like to hear this too often, but it's the highest in the G20 at 360%. That's kind of a scary number. Compare this to 225% in 2008 and the current G20 average of 290%. This obviously leaves some Canadians exposed to vulnerable rate hikes, right?
Canada really takes its guidance, if you will, from the bigger countries. They look to the EU, they look to the neighbors to the south here in America. Canada doesn't really set its own monetary policy. It's kind of follows suit, if you will. So if the balance of the G20 all start to raise rates, Canada will too, whether they like it or not. And with the highest GDP ratio here of the G20, it does leave this country the most exposed. So there is some potential inherent risks there until that starts to come down to more of the average levels.
And I think people are seeing that too, or feeling that anyways, because consumer confidence is waning. 10 weeks in a row now. July saw the high at 67%. That's now down to 58%. And if you look at consumer confidence in simply the real estate outlook, it's not great. It peaked at 68% in June, which was a very good number, and now it's down to 50% today. And that could be for a multitude of reasons, right? Whether that's on financing the cost of financing going up, the troubles of recent inventory lags, not enough product on the market, rising prices. There's a lot of things there that are probably influencing the way people feel about consuming in the real estate market.
Yeah, totally agree. I think the good times peaked around spring, I think, of this year, summer, and naturally it's going to change. We can't have this much money flood the system and not have repercussions, and we are having the early sense of that now. Prices are high, rates are raising, inflation is high. It's naturally going to change people's sentiment, and that's going to start to affect, definitely the real estate market upcoming months. Foreseeable future, I think, our final thoughts here are we're going to expect prices to continue to rise. Yes, we talk nationally, but especially here at home, at least through Q1 2022. Single family homes will continue to be the hardest to come by. Those are going to continue to see the greatest price appreciation rates compared to the other two asset classes. Ryan, what else is kind of our final thoughts here today?
Well, Canadians are obviously still flush with cash. Curb payments having just come to an end. Consumer confidence is not great, but at the end of the day, with a lot of businesses looking for people, this is kind of the opportunity where we can restore some of this consumer confidence if we get a lot of people back to work and that money starts to flow through the economy, stabilizing inflation, right? That being said, on the current pace of things, I think you'll see rates and inflation continue to rise, and that maintains the biggest threat to our current marketplace.
Perfect.
To me, I think that kind of summarizes. It's a bit of a heavy data one, but a lot of very important data.
Long one for you guys today, but there was a lot to cover and lots going on in the marketplace. We wanted to make sure you guys were well informed. Thank you so much, especially if you made it this far. Thanks for watching. Do subscribe. We do this every Saturday morning for you. And thanks as always. Have an awesome day.